Let's get more then on your questions about the crisis after last week's mini-budget and answers from our panel of experts. Let me introduce them. They are Gemma Godfrey, who is a personal finance expert. Welcome, Gemma. Sonia Matharu, who's a mortgage broker and mentor with the Mortgage Mum. Hi there, Sonia. And Yael Selfin, who's chief economist at KPMG, one of the big four accountancy companies, of course. Very good to see you, Yael. Well, now let's kick off then. Lots of questions coming in, a wide variety of aspects of this economic crisis that we seem to be facing. And this first one, big picture stuff, I suppose. And it's looking for an instant solution. It's from Spencer, who says, if the Chancellor were to do a U-turn on his mini-budget, would that fix the current issues? Wipe it from the record, I suppose. Yael Selfin, that would mean, it's not just the additional rate tax cut, is it? It's the basic rate cut, stamp duty cuts, national insurance, corporation tax. There was a lot in there.
Yes, absolutely. I guess it's very unlikely to happen. And also probably one of the key issues that we're having at the moment with the market is that they lost confidence in the Chancellor and in the direction that the new government is trying to take. So a U-turn would not necessarily fix it, because we do have major problems in the UK at the moment, short-term, trying to protect at least those very vulnerable households that are affected particularly badly by the higher energy prices, but also the longer-term problems with weaker growth. So we do need action, and just a U-turn would not really solve it.
Well, would a halfway house be another statement of clarification from the Chancellor? And the thing that was missing on Friday, which was the accompanying judgment of the Independent Office for Budget Responsibility, which the markets didn't seem to like. And that's really about how you're going to pay for it all.
Yeah, absolutely. That was certainly missing. But also beyond that, we probably needed a little bit more clarity as to how the Chancellor was planning to reach the 2.5% growth that would hopefully pay for quite a lot of it. So it wasn't really clear how that would happen. Just by cutting taxes, it's unlikely to make it happen, and therefore markets weren't really believing the plan. So there'll need to be more clarity on that as well.
Well, that is the big picture. Let's get now into some of the detail and some of the questions coming from our viewers and listeners. This from Mazin, asking, will we see a collapse amongst the mortgage providers? What do you think, Sonia? Because, of course, we've seen so many mortgage providers, well, stop lending, and, that's what they're around to do.
Yes, so what we're seeing at the moment is a pause in the market. So lenders have taken a step back, just reflecting on obviously what's been happening, and they're working really hard behind the scenes to get themselves back on the market. So there's just a few decisions that obviously need to be made. It's not a collapse. They are not going under or anything like that. They are simply just taking a moment to reflect and review things, and then they are putting plans into place to come back onto the market. Now, we have seen a lot of lenders obviously pull out this week, but even just today I'm speaking to some of them, and they're saying that it's likely they'll be back on the market by the end of this week, which is obviously good.
But, what we know, Sonia, is that they'll be back with much higher rates, and that further down the line could lead to defaults, and then that puts the pressure on the mortgage providers. They're not getting paid back.
Yes, yeah, and I guess it depends on where you are with your mortgage at the moment. Of course, if you've got a fixed rate mortgage, then it depends on where you are in that fixed rate, but your monthly payments have been fixed for a set period of time, so you won't be affected by that. But of course, if you are coming up to a remortgage soon, you may be it is likely that your monthly payments will be higher than what you have been used to paying.
OK, another specific question from Tommy. Maybe you could answer this for us. Gemma, here it is. I recently received some money. Should I use it to pay off my student loan, put it towards my fixed rate mortgage, or invest it? Well, that's quite a nice position to be in. So Tommy's got some money. What should he do with it?
I mean, that's a fantastic position to be in, to be able to try and decide where to allocate the money. And interestingly, paying off student debt is something that keeps coming up. The challenge there is that it really should come lower down the pecking order. So one of the most important things to be able to do is to make sure that you are saving for a rainy day fund, to make sure that you're paying towards your pension before student loans, because obviously there's a certain element of debt forgiveness. So after a certain amount of time, 30 years or so, if you haven't paid back all of your student loan, it gets written off. And so if you, at this stage, decide to overpay on your student loan and let's say come into financial difficulty later, you can't go backwards. In terms of your fixed rate mortgage, and obviously people are concerned about mortgages because, I mean, there are over 2 million households who within the next 2 years are going to come to the end of a fixed rate. And I don't think we got that detail from the question. But if someone's concerned about coming towards the end of a fixed rate mortgage, then, you know, being able to try and reduce that debt obviously could help them longer term, because it is going to be getting more expensive when they remortgage. But of course, if when we're talking about at a fixed rate, it's a fixed rate and it's very, very low, then paying that off is going to only see you marginally improve your situation. Whereas putting your money towards, future growth could potentially do better. But again, caveats there are, at the moment, even though we're seeing interest rates rise, we're seeing interest rates rise on debt, not necessarily on savings accounts. And so because they're so low, it's still a challenging time in that respect.
I think we get into that with another of the questions. I've got another very quick question for you, Gemma, and I think the answer is going to be a 3-letter word beginning with Y. Are my premium bonds safe? Asked Lucy.
Yes. So that would be the simple answer.
That's what I thought.
It's backed by the Treasury rather than a bank. So it should be safe. I mean, never say never, but, it should be safe. The British government hasn't defaulted. If the British government's defaulting, we have a few other massive problems that are there. The risk that you take, because the word there was safe, the risk you take with something like premium bonds is on the return you're getting, because they don't always give market-leading returns. But generally, in terms of savings in general, there's a certain limit, £85,000 that it should be covered by the Financial Services Compensation Scheme. When it comes to premium bonds, again, backed by the Treasury, hopefully your capital will be protected.
OK, yeah, we'd be in a really bad state, yes, if that was not the case. One on mortgages. So, Sonia, my fixed-term mortgage runs out next year. I'm worried about the interest rate rising. So should I pay to exit early and get a 5-year fixed term now, or can I extend my current fixed period? That from James. So runs out next year, the fixed term.
Okay, yeah. So honestly, it depends upon your personal circumstances and your financial standing. If this is something you are considering, I would really strongly advise that you seek professional advice from a qualified broker, because there are numerous factors to consider here, such as early repayment charges. And what you don't want to do is make costly decisions from fear. So make sure you speak to somebody and get all the advice and all the information so that you can make an informed decision moving forwards that's going to be really suitable to you. It's a tricky one to answer without knowing the full personal details, but seek advice and make sure that you get the right outcome for you.
And do those costings, because there always are exit penalties, aren't there, from a fixed rate. This is about, I suppose, partially our next question about what was going on today. Al Selfin, can you deal with this? What is the risk to pension pots? Now, I think for a lot of people, this intervention by the Bank of England came from a clear blue sky in an area that, I mean, even for those that pay attention to the markets, a run dynamic, whatever that may be. What was going on? Are pension pots safe?
I mean, the problem was with the yields. The yields were going very high, and that put some pressure on pensions because of the costs involved and their exposure. But what the Bank of England did was essentially to intervene and to cause the long-term yields to fall quite effectively, in fact. So I'd say we are in a better position, and it probably prevented the more major turmoil in market at this stage, but ultimately I'd say investments can go up and down. The investments you have in a pension, the value of it can go up and down, and this is not something that the Bank of England can ultimately guarantee.
And here's, thanks for that. Here's a question then about, I suppose, the push me, pull you nature of government policy and Bank of England actions, of course, as well. This from Simon asks this, Sonia, how are tax cuts supposed to put more money in our pockets if the mortgage rate is also going up? Swings and roundabouts.
Yeah, it really is swings and roundabouts, especially a lot of people at the moment are experience increased costs from all angles. Not only interest rates are going up, we've got also the cost of living as well, and it is a difficult time for many. But what I would want to, the message that I would want to put out there is that there is help. And sometimes as well, so you can sit there and really worry about things, but there are also answers out there and solutions, really. So again, it goes back to what I said earlier, is making sure that you seek professional advice, from somebody who can really sit there and help you through. There's always things that can be done. I think at the moment, a lot of people are seeing just the cost of everything going up and thinking, how can I afford this? I'm not going to be able to afford my house soon, and someone's going to take it away from me. But there is a lot of things that can happen between a lot of things that can happen before that does. So just make sure you speak to somebody if you are concerned at all, because there is help out there for you.
That's good to hear. Where is the time going? We're nearly out of it anyway. Here's a big question. Gemma, maybe you hear from Yale on this as well. Gemma, why is the drop in the pound a bad thing? Well, it isn't necessarily, is it, if you run a business and you export to the United States and things like that?
Exactly. If the pound gets cheaper, then obviously the value of our exports get more competitive. We still earn the same amount of pounds, but against a more locally, driven companies, our exports are better. However, we're in the UK, and the problem with having a weaker currency is that the goods that we import, and we import a lot of food, and we import a lot of fuel as well. So it means that right now, when we're really battling a cost of living crisis with all the prices of everything, across the board, really, going up, having a weaker currency so that anything else that we get externally and having that being driven much, much higher and much more expensive is obviously going to cause a lot more pain longer term.
Well, I'm afraid we are totally out of time. Gemma, thank you very much indeed. Sonia, very good to see you. Yael, thank you all for your expert input. And we'll be back with you very soon. Coming up, we'll have more of your questions on the situation, including those on saving accounts and the value of the pound. Let's get back to the questions that you've been sending in. And I think my expert panel by now. This is coming from Max. Max asks, I have some money in a Help to Buy account. Should I keep it there or move it? Gemma, what is a Help to Buy account? Clearly it's to do with housing.
Yeah, it is. It's government support that will contribute towards the ability for you to be able to save towards a property. But I think the challenge is around the Help to Buy scheme is, of course, the limited time that's left available on it. And of course, in a market like this, with properties getting more and more expensive, people are going to need a lot more support out there, and mortgages getting less available. And of course, there being less choice in the marketplace. We saw 300 mortgage deals pulled yesterday alone. So I think there's a lot of different moving factors there, which will determine whether a scheme like that will be appropriate.
OK, another one on mortgages. Sonia, after years of saving, I'm almost in a position to buy a house. Where does this imminent rise in interest rates leave first-time buyers and younger people looking to buy a home? That from TK. So, yes, an imminent rise in interest rates, but also in the budget, there was quite a large increase in the exemption from stamp duty, wasn't there, for first-time buyers?
Yeah. Yes, absolutely. You're right. So, they are going to benefit from those stamp duty changes there. But going back to the question, my advice really would be, again, to speak to a professional, speak to a mortgage broker and see what your potential mortgage could look like for you, because it's really scary listening to everything that's going on at the moment and also making it relative to you. So I think it's really important to get professional advice and guidance, speak to somebody who can sit down with you and talk through what this mortgage could look like for you, what it could look like on a monthly basis as well, with those monthly payments. And then once you've got this indicative information, you can then make an informed decision. And then also start to look at it a bit holistically as well. So can you afford those monthly payments? Because obviously, you know, as a mortgage broker and lenders, there's affordability calculations. So what we could say is affordable as well, but it has to feel right for you. Also, what would my lifestyle look like if I was to, you know, proceed with this now? And all of these kind of things are very important. Like, I don't think we should ignore our gut feelings and our personal feelings when it comes to this. Like, it's a very emotional process and a very emotional purchase. So, you know, those factors are important. So don't base your decisions solely on the market or also what your friends and family are doing, because it's got to be what's right for you. So yeah, that would be my advice to anyone that's looking to purchase at the moment.
Thank you for that. Let's concentrate on stock markets here. We've got a question from Stuart simply asking, how will this affect my shares? Yael, we've seen stock markets, of course, fall. Well, they've been falling over most of the year, but I mean, no collapse, no great kind of crash yet.
Well, I mean, it is very difficult to predict. We are seeing high volatility. We also potentially, depending on how this evolves, we could see a stronger weakness in the actual economy, and that would lead into potentially weaker stock market. But ultimately, we need to understand also that there's a lot of companies that are quoted on the stock market that export quite a lot, especially the larger multinationals, and a weaker pound favors them because they have quite a lot of earnings that are denominated in other currencies. So ultimately, it's not that clear cut.
So there are opportunities out there depending which part of the world you put your money in.
Yeah, no, definitely. I mean, the global economy overall is slow, and we've just launched our global economic outlook report, and it's not looking great across many countries. But there's some areas where there's more weakness than others. There's some countries that we would expect to be a little bit more resilient in the next year.
Okay, well, following on from that is Brian's question, asking, where is my money safest, investments or savings? By investments, I suspect Brian means the stock market shares or cash savings. What do you think, Gemma? I mean, interest rates are going up. Presumably, savers will see better rates eventually, but you're always told, aren't you? People like you always say that for the longer term, you're better invested in stocks and shares because of dividends.
Okay, so yeah, it's really important to also to clarify the word safe. You know, where are you safest? Because on the one hand, if you really, you know, your money under the mattress, staying in cash is the safest thing because you've got a limited loss. But in another respect, you're guaranteed to be worse off because of inflation. Your money isn't going as far as it used to. So then you go to cash savings accounts that, you know, can offer you a bit of interest in terms of a return on your money. So that's, you know, a little bit better still. But again, that interest usually doesn't keep up with the rising cost of living. And absolutely, as you said, there is investing. With investing does come risk. So yeah, of course, there are some things that will pay you dividends, but just in general, when it comes to investing, you're also almost guaranteed to see a dip along the way, which is why the most important thing there is to make sure you have enough cash savings to start with, an emergency fund. And then if you're looking at investing, be able to invest for at least 3 to 5 years and really in line with how comfortable you are at seeing it dip along the way as well.
And just a quick thought on that then, yeah, I mean, another aspect of fall in share prices and certainly a fall in the value of the pound is that the UK companies become cheaper to international predators.
Yeah, not just UK companies, UK assets more broadly. So we could potentially see stronger FDI and stronger investment, foreign direct investment, although that tends to be with a fairly longer time lag in that sense.
Well, listen, we are fully out of time now. Thank you all once again. Yael Selfin, Sonia Matharu, Gemma Godfrey. Very good to tap your brains there. Thank you very much indeed.